Hi everyone, Nick here, welcome back. Fidelity research suggests that for most people, only 38% of their retirement income may come from Social Security or a pension. That means you may need to fund 62% of your retirement expenses from investments or earning income. Social Security and Medicare provide a good baseline, but you are on your own for a lot of your spending needs. This is a very important subject for retirees, especially asset allocation in retirement, because asset allocation is responsible for up to 90% of investment returns. In this video, we'll discuss different viewpoints on asset allocation in retirement, top retirement risks, model portfolios, and how it all relates to retirement asset allocation. I recently read an article that was questioning if retirees are taking too much risk, that they're investing more like 30-year-olds than retirees. This is because data from Fidelity and Vanguard showed that about 40% of 65 to 69-year-olds have over a 66% stock allocation. Now, this is in contradiction to what was a rule of thumb known as age and bonds, which basically said 100 minus your age should be the amount you have allocated to stocks. So if you're 30, maybe 70% in stocks, 30% in bonds. Or if you're 65, 65% in bonds and 35% in stocks. Now, what we're seeing many retirees do is actually the opposite of this rule. In this rule, many people think it's too conservative. They've updated it to 120 minus the age. So in addition to the age and bonds rule of thumb, another study is quite popular and used in retirement planning, and that is where the 4% rule comes from. That's William Bengen's study, where he studied 30-year retirements and determined that a 4% withdrawal rate worked quite well in lasting the 30 years without running out of money. Now, a lot of people in the FIRE movement adopt this and treat it kind of like gospel, even though their retirements may be drastically longer than 30 years. In some cases, 60 to 70 years, which case I would caution this might be a bit too aggressive. However, for the average 30-year retirement, people retiring in their mid-60s, this is quite good research. And what William Bengen said was he thinks it's appropriate to advise the client to accept a stock allocation as close to 75% as possible, and in no cases less than 50%. That is because by having a very low allocation to stocks in your portfolio, it can actually expose you to additional risks. We'll get into those in a minute. But first I want to look at a chart from Wade Pfau. He took the data from that William Bengen study and he put it in this chart. So you can see the retirement year on the x-axis, and then on this axis is the maximum sustainable withdrawal rate. So you can actually see the portfolio with no stocks had the lowest sustainable withdrawal rate. That's because you need the growth from stocks to outcome inflation, costs, and just grow your wealth more over time. Oftentimes entering a 30-year retirement, you may not need a lot of your money for 15 or 20 years, so you can afford to take some more risk, and you may even need to take some more risk to sustain a better withdrawal rate and quality of life. When we go up to 100% stocks, you can see that's quite volatile and often dips quite low. Many people probably couldn't stomach that. But he's saying 50% should be the floor. That was his general recommendation, just this middle line. And now we have yet another approach to asset allocation and retirement. This is from target retirement date funds. Many companies offer these. They're often the default option in the 401k plan. You can literally buy this one fund, and they manage the asset allocation for you over your lifetime. You buy that fund based on the year you expect to retire. So they might have a 2060 target retirement date fund for people that are going to retire in 2060. So this is what's known as the glide path, and this is a visualization of how these funds manage the asset allocation over time. This one is from Vanguard. So they have 4 phases in their glide path. In the first phase, it's fixed, 90% stocks, 10% bonds. Then they divide those between international and US. And then in phase 2, they gradually start decreasing the stock allocation and increasing the bonds. Till at age 65, which is when most people retire, that would be 50-50. And then the terminal point is at age 72, where it drops all the way down to 30% in stocks and 70% in bonds. And then it stays there for the remainder of the period. So this is actually maybe a bit closer to the age and bonds strategy than what William Bengen was talking about. However, it is not exactly that. It is quite close at age 72. And some people would say that this is far too conservative, such as William Bengen. So there are a lot of different opinions here. We have the age and bonds rule. We have the target retirement glide paths, which are quite similar to age and bonds. And those are quite conservative. And then we have the William Bengen study in William Bengen that suggests that maybe 50% or more should be allocated to stocks even in retirement. And that's where maybe we see about 40% of people, 65 to 70, have a surprisingly high stock allocation at over 66% in stocks. I was actually a bit surprised when I saw that. So now I wanted to show you some different model portfolios from Vanguard to set the baseline for how we can think about asset allocation in retirement. So they have a bunch of these different portfolios here, ranging from 100% bonds all the way to 100% stocks. So I went ahead and I put these in a table to make the data a little bit easier to consume. So what we want to look here is we go from 100% bonds all the way to 100% stocks. Some interesting data here. You can see the average annual return historically, the more stocks you have, the better it is. And that correlates to the best year you've had generally. However, it almost definitely always correlates to the worst possible year you could have. So the 100% stock portfolio, you're looking at possibly losing half of your retirement portfolio in 1 year. That would be very difficult for most people to stomach when they're relying on that income. Remember, it's got to provide a lot of people 60% or more of their retirement income. Then we can just see the number of years with a loss over a 96-year period. So the ones with the least amount of loss were in these ranges, and those are quite conservative portfolios, similar to what you see in the age and bonds or the glide path. However, William Bengen, his approach is generally in this range, where you're going to have a much higher return. You'll also see some larger drawdowns in your worst years. They might not be that significantly higher. Some people may not be able to stomach those. So this is how we can think about some of these model portfolios. These model portfolios are a good starting point for how we think about asset allocation in retirement. Now, all of them are simple broad market index portfolios. And these are the only portfolios I recommend to almost everyone. I've made videos on why I think index funds are the best, why I think the 3-fund portfolio is the best for most people. And this is because data I often cover, over 95% of professional investment managers' active funds fail to outperform simple index funds. The average investor earns returns below buy and hold strategies in basically any asset class. And just like games at the casino, deviating from market-based portfolios is not a game that I think you should play. I've heard stories of people I knew who lost nearly their whole retirement portfolio by going too heavy on one company that didn't do well or went bankrupt. These stories are devastating, but they are completely avoidable. There are enough risks to investing and retiring. There is no point in taking unnecessary risks. Before we discuss those retirement risks, my channel focuses on sound investment principles and planning strategies. And best of all, it's free. If you value this content and want to support free financial education, make sure to press the like button and subscribe. So now we're going to talk about the risks in retirement. First is the sequence of returns risk. If you retire right before a market downturn, any money you spend won't be able to recover with the market. and down markets can last a decade or more. I think a lot of people start out, they look at a portfolio visualizer like this. We're starting with $1 million. And then in this scenario, we're spending $10,000 per quarter, inflation adjusted. So it's about 4% per year. We have 3 portfolios, 70% stock, 30% bond, 50-50, and 30 stock, 70 bond. So when a lot of people look at this, I think they just look at the history and they say, okay, well, the higher stock portfolio obviously did the best. And who doesn't want to end up with that inflation adjusted $2.7 million portfolio instead of the 1.8 million or 1.1 million with the more conservative portfolios? However, you do have to remember that in this case, this portfolio dropped by about 38 to 40% before starting to recover, whereas the more conservative portfolio was a much more mild drop. You may note that the difference in the return percentages actually doesn't seem to be quite that high, but over such a long time period, it makes a big difference. These are the final balances up here. I don't think they're inflation adjusted. This graph, I've made it inflation adjusted. So I think a lot of people stop here and they don't consider, this is like the happy path. They don't consider what could go wrong. So one example could be you retired in 1999 and you just got really unlucky with the year you happened to retire, completely outside your control. So 3 years into your retirement, with the higher stock allocation, you see it plummet to 700,000. Whereas the more conservative bond portfolio with higher percent in bonds, 70%, would have only dropped to 870,000. Remember, you spent 120 over that time period, so it's actually not really that bad. However, how would you feel? The markets, when this happens, everybody in the news is often saying nothing like this has happened before. People are talking about how many never recover and this time it's different. And are you going to be able to sleep well at night after this has happened? A lot of people wouldn't be able to, and that's probably why they go with the more conservative portfolios. So let's say you could sleep well at night and you managed to hold on and you didn't change anything. Well, you did reasonable and, gradually recovered over the next few years. But then come 2008, you would have seen your portfolio plummet. So you're now 8 years into retirement. You retired at 65 maybe, you're now 73. And you're looking at possibly living into your 90s. And you've already lost almost half of your starting portfolio. You're now down to just under $600,000 with that 70 stock, 30% bond portfolio. I know a lot of people were freaking out about how it might just get even worse and never recover. Now, if that was you and you sold and went into bonds at that point, you would have locked in permanent losses and you may have not been sleeping well at night. So if we go all the way out to current date, starting in 1999 with this scenario, it took a long time for that 70% stock portfolio to recover and outpace the 50-50 or the 30 stock 70 bond portfolio. It wasn't until 2017. So think about that. If you retired in 1999, would you have been able to take 17 years of underperformance, possibly second guessing yourself, well, if I had just had some more bonds, I wouldn't have lost so much of my money, and maybe I would be doing a little better. I could sleep better at night. I'd be more comfortable. Would those thoughts have weight with you? Maybe you would have given in. I guess that's something for you to judge for yourself. But all of these portfolios actually did quite well. So when we go back to the 4% rule that William Bengen was talking about, I mean, you did have quite a scare here in 2008, but they all still retained quite well and stayed pretty stable over time. And now you'd be over almost 25 years into retirement and still have a pretty sizable portfolio. So that's the first risk, and I think it's very important to consider this and how you would react if you get unlucky with when you retire. The next main risk is longevity. So here we're going to go to this chart from Fidelity. And most people don't realize the odds of them living quite long. So when you look at the odds just for a male at age 65, there's a 50% chance that they lived to 87 and a 25% chance they lived to 93. And when you have a female at age 65, it's a little higher because women tend to live a little longer. But for a couple, for one of them surviving, there's a 50% chance that one of them lives until 93 and a 25% chance one of them lives until 98. So that's pretty close to the 30-year retirement if you're retiring at age 65. I think a lot of people underestimate this and they think they're going to die earlier, which might be the case for one of you. There's a pretty good chance that for a couple, one of you is going to live into the mid-90s, possibly even higher. If you're getting into the 10% chance, one of you is probably going to live over 100. The next risk we have is inflation, which is quite timely now, since we're coming out of a year where there was basically 10% inflation. So if we look at the chart from Fidelity, over a 25-year period, inflation just at 2%, which is the rate the Fed targets, can take 2 out of every $5 you have. So you lose 2 out of every $5 to inflation over 25 years. So you need your investment portfolio to overcome that. And at 4% inflation, it would actually be over 3 out of every $5. And when you look at the cost of healthcare expenses have been rising at 5.4%. That's actually quite high. And when we compare that to returns on more conservative portfolios, the healthcare could potentially outpace conservative portfolios. So that's an interesting thing to consider, is how inflation and rising costs of healthcare can affect your retirement plan. And the final risk is asset allocation. You want to be able to choose an asset allocation that works for you. It's a very personal decision. It needs to be aligned with your goals. Everybody's goals are different. Some people want to take a lot of trips when they retire. Some people want to make large donations to charity. Some want a large legacy for their family or heirs. Some want to pay for their grandkids' college, and so on. There are a lot of variation in these different types of goals. And then everybody has a different need, ability, and desire for risk. If you don't have enough money to fund your retirement, you may feel like you need to take more risk in order to make up for not having enough money. You might try to earn more of it by taking more risk. It could backfire, but that's something some people do so they don't have to definitely settle for a lesser lifestyle. Now, if you have more than enough, you've basically won the game, and maybe you feel like you don't need to play, so you just have a conservative portfolio, because why take more risk when you have more money than you need? You're definitely going to live a comfortable life, so why risk losing it? And then some people have pensions that should provide all their needs, others don't. Some people have children to help care for them, maybe mitigate some of the medical expenses, some others don't. So when you talk about asset allocation, it needs to be something that considers all of these things, and it needs to be personalized and something that you are comfortable with. So these risks have different trade-offs when it comes to asset allocation. A too conservative of an asset allocation can lead to challenges with inflation. That can really hurt. If there's a lot of unexpected inflation, you have too conservative an asset allocation. Think about what happened the last couple of years. Then healthcare costs, we see that's a big factor of inflation. And if you look at the amount of money the average retired couple will need for healthcare, Fidelity estimates that at $315,000. And that's just to cover medical expenses in retirement, excluding long-term care. So this is in addition to Medicare. So they have a breakdown of where all that money goes, but their estimate is $315,000 in addition to Medicare. That's a lot of money, and that doesn't even count long-term care. So that's a big risk. You need your portfolio to be able to sustain that type of spending. And having stocks gives you a better chance at getting that growth. And then there's longevity, the same reason. You might live a lot longer than you're actually expecting, or one spouse in a couple may live a lot longer. So that's where the stocks can help. And having too conservative of a portfolio can hurt. But then on the flip side, if you have too aggressive of a portfolio, you expose yourself to a sequence of returns risk. And this is basically just pure luck. It's like you're rolling the dice and you either get lucky or you don't. And if you don't, it can really hurt your retirement and your ability to live comfortably. And then that's another big thing with this is even if you don't run out of money, you might be sleeping poorly, you might be stressed out, you might make bad decisions and lock in more permanent losses that could have been avoidable. So you need to consider how comfortable you could be with the asset allocation. So to recap, you may need to self-fund over 60% of your retirement spending. Experts disagree on the best approach to retirement asset allocation. Every one strategy likely needs to be unique. You need to consider all these different risks and your goals and how they fit together, and come up with a strategy that you're confident in and you'll be comfortable with. I made some other videos on how to stress test retirement asset allocations and withdrawal strategies, retirement income planning and retirement withdrawal strategies compared. I'll link those videos below. They may help you dive deeper into these different types of strategies. But this is a broad overview of how you should think about asset allocation and retirement. I'd appreciate if you comment below and let me know which retirement asset allocation you think is best for you. It's a really interesting thing to discuss and everyone is different. If you got value from this video, make sure to press the like button and subscribe to support free financial education. Thanks everyone, later.